The big boy Reliance Industries delivered a huge the third quarter great numbers and becomes the first Indian private sector corporate to cross the 10,000 crore quarterly profit mark. Retail revenue on your screens there up a whopping 89% with EBIT tripling to 1,500 crore rupees. Gross refining margins also coming in at $8.8 per barrel, exceeding what the street was expecting. So definitely good news coming in, and you can expect some reaction on that stock come trade tomorrow. Let me take it across to my colleague Ajay Sharma, who's joining in with more details and crunching the numbers for us. Ajay, I'm sure the street is going to be very happy with these set of numbers.
Well, in the face of muted expectations this time around, Reliance Industries has come out and surprised the street. Both the bottom line and the top line are a beat compared to what the street was estimating. Even refining margins at $8.8 are not as weak as the street was actually estimating. However, the big two areas which have done very well and probably are responsible for good numbers, the retail end of the business has done very well. The sharp subscriber addition in Jio has been higher than the estimate. The ARPU number at 130 is again higher than what the street is estimating. And the Petchem also came to aid because the volume jump is almost
down 4% quarter on quarter. Throughput of 18 million tons during this quarter. This quarter was really marked by a very sharp contraction in gasoline spreads. They dropped by nearly $7 per barrel. And given on the full production, that is equivalent to over $2 per barrel reduction in gross refining margins. As far as benchmark Singapore refineries are concerned, the drop in gasoline was to some extent offset by the strength in fuel oil, but overall still a negative performance. As far as we are concerned, we took the headwinds of lower gasoline margins and higher fuel oil costs and offset that by stronger middle distillates, changing the crude mix, going for a lighter crude slate, sourcing more crude from the US, tight risk management, and operating the plants to the highest possible 18 million ton throughput. We also had our retail outlets continue to improve the throughput, and we continue to lead the industry in terms of volumes per outlet. Upstream, a slightly better quarter than the previous one, with EBITDA at 511 crores. Essentially, as we have given up the FPSO, their hiring charges did come down. We also had slightly better gas realizations both in the domestic and the US markets. And most importantly, our development project is on track, and we do expect gas in the second half of 2021.